Let's talk about ARMs. Adjustable rate mortgages. What are they? How much do they adjust and when? And are they good or are they bad? What is an ARM? It's a mortgage with an interest rate that can change. A fixed mortgage is a mortgage where the interest rate stays the same over the entire term of the loan. But with an adjustable rate mortgage or an ARM, the interest rate adjusts. The important question for you is, when does it adjust and by how much, right? So banks can make up any kind of loan, but the most common ones are 3-1, 5-1, 7-1, and 10-1. But there are many other kinds. There's 3-3s, there's 2-2s, there's 5-5s, there's 3-2s, basically anything that the bank's creative and wily minds can find a profit margin in. So the answer to the first question, when does an ARM adjust? You want to look at the first number. So in the example of a 3-1, you're going to spend 3 years at that first initial interest rate, and then your loan is going to adjust. If you have a 10-1, you'll spend 10 years at that initial interest rate, sometimes called a teaser rate, before that loan starts to adjust. Now, as a general rule of thumb, the shorter the period to adjustment, the lower the initial interest rate you'll have. So for a 10-1, you'll generally start out at a higher interest rate than you would with a 3-1. I know what you're thinking. You're thinking you want the lowest rate for the longest period of time. I mean, who wouldn't? But that's not the way it works, unfortunately. Okay, so for the second part of the question, how much will an ARM adjust? So we're going to look at what happens. But when you get your ARM, there's a couple of pieces of information that you might not notice. One is called the margin, and one is called the index. And these two together determine in the future how much your loan will adjust. An index is a man-made financial instrument that goes up and down with the economy. And they have different names such as 1-year LIBOR, CMT, MTA, and they go up and down like interest rates, but they are not interest rates, they are indexes. You don't know where your index will be in the future. No one does. But you can get a sense of what it has been by looking at historical charts. It'll give you a good idea of the range, the recent range for your particular index. Every ARM has an index. So if you have an ARM, you can go into your original loan documentation and see what index it's on. It'll say in there. And then you can track it over time. Just Google it, look it up, see what it is today. The margin is a number, typically between 2 and 3, depending on your riskiness to lend to. So to see what your ARM will adjust to, all you need to do is see what your index is and add to it what your margin is. And that makes up your new interest rate. Voila! Let's say that you have a 5-1 ARM. So you pay your initial rate, let's say it's 3.75 for the first 5 years, and the first month after that, your rate will adjust to the index plus the margin. Now what's the second number in a 5-1 for? Well, that's how often your loan can adjust. So after that initial period, it can adjust once a year. If it was a 2, it would adjust once every 2 years. So you're probably thinking, oh God, how much can my loan possibly go up? Oh my God. But the good news is that you also have in your loan document caps. So it's a limit on the amount that your loan can adjust at any given time, typically 1% or 2%. So it can't go up more than that. You'll see in your loan documentation what the cap is for adjustments. The other thing is you're going to have a cap on the maximum interest rate that you can pay, which is typically 6% over the starting interest rate, sometimes 5%. But you'll want to find that in your loan documentation also, know what that maximum amount is. Your interest rate could also go down. Yes, it could. If the index goes down or it plummets, your caps would apply going down as well. So you'd never drop more than 1% or 2% or whatever's in your loan documentation. Ooh, my brain hurts. This is hard. Let's take a break. Do you have an arm? Let's recap with a film called A Day in the Life of a 5-1 Arm. Mira is buying a house. Congratulations, Mira! She is getting a 5-1 arm at 3.75% starting interest rate on a $400,000 loan, making her mortgage payment $1,852. According to her loan document, her index is a 1-year LIBOR, her margin is 2.5, her annual cap is 2%, and her lifetime max cap is 6%. For 5 whole years, Mira pays her starting interest rate and monthly payment. But on the first month of the 6th year, the 1-year LIBOR is 1.80. Psst, this is only an example as no one can predict the future. We know that Mira's margin is always going to be 2.5, and so the new interest rate is 4.3, which makes her new payment $1,979. Because her loan adjusts every year due to the 1 in the 5-1 arm, the next year it resets to what the 1-year LIBOR is then. She has a new interest rate and a new payment. And then the next year again. And so on. And on. And on and on and on until the end of the 30 years. With her interest rate never going up or down more than 2% over the previous year according to her annual cap. And with her interest rate never going above her starting interest rate plus her lifetime maximum cap. The end. So this stuff is really confusing. Yeah, that's the point. If banks wanted you to know how these loans work, they would explain it to you in a way that you can understand and in detail, but they don't. So for the answer to our final question, are arms good or are arms bad? Well, they're not bad, because if you get one and you sell or refinance before the rate adjusts, you can enjoy this very low rate, lower than a fixed rate, and save a lot of money. But you want to be fairly certain that you can get out of that arm and you can refinance. You want to be confident that in the future you're going to have enough equity in your home and you're going to have the income and debt profile that allows you to qualify for a new mortgage in order to refinance. Most of all, if you get an arm or if you have an arm, you want to understand exactly what the best and worst case scenario is going forward so there are no surprises for you. And I know it's confusing, but that's also why we develop tools that let you tell exactly what your future looks like with an arm, no matter if you have one now or if you're considering one in the future. I want you to be fully in control so that you can take advantage of all the opportunities available for you while avoiding all of the risk.